New data from Cox Automotive and Bloomberg show that America's auto industry is under financial strain, but not in freefall. After several years of high vehicle prices, rising interest rates, and stagnant wages, millions of households are finding it harder to keep up with car payments. Now, the question is the market showing signs of adjustment or collapse? Cox Automotive estimates that the share of defaults ending up as repossessions declined from the more typical 80% in 2020 to below 78% in 2021. As a result, 2021 likely saw approximately 1.1 million repos, down from an estimated 1.3 million in 2020 and 1.7 million in 2019. That number rose slightly to about 1.73 million in 2024, making it the highest level since 2009. Early 2025 data suggests that repossessions are tracking at a similar or slightly lower run rate compared with last year, with no evidence of a surge. The uptick in repossessions reflects broader affordability pressures rather than an outright credit meltdown. Delinquency rates remain elevated compared to pre-pandemic averages, especially among subprime borrowers, but remain low, far below the crisis levels seen during the Great Recession. However, this has not stopped growing concerns about a potential recession. Analysts point out that rising auto delinquencies often serve as an early warning sign of consumer stress. With household savings depleted, credit card balances at record highs, and borrowing costs still elevated, even a modest increase in job losses could push more borrowers into default. Economists warn that the auto market, while not collapsing, could be signalling deeper weaknesses in the broader US economy, where consumer spending accounts for roughly 2/3 of total GDP. Another alarm bell has started ringing as Cox Automotive has quietly revealed the repossession rate returned to 2019 levels, while auto loan defaults are higher. Digging into the numbers, there were 2,332,837 car loan defaults last year. That's a staggering number, and it even eclipsed those during the peak of the Great Recession. Last year's default rate was 3.13%, which was the highest since 2011. However, that trend started with the Great Recession, as the default rate was 3.18% in 2007 and jumped to 3.76% in 2008. It then peaked at 4.12% the following year, before slowly settling back down to the 2% range. Car ownership costs have risen dramatically. The average new car payment now exceeds $750 per month, while used car payments average over $550. At the same time, most households are earning less in real terms. According to CBS News, a large majority of Americans say their incomes aren't keeping pace with inflation, as they report prices around them either rising or staying the same. There's wide concern about the ability to save or buy extras. As has been the case for years, prices drive so much of Americans' larger views. They say this factors the most into their assessment of the overall economy, which most continue to say is bad. And then among those who say their own finances aren't good, prices are the top reason why. A PNC Financial survey found that 67% of US workers surveyed say that they are living paycheck to paycheck. That's up from 63% last year. This paints a troubling picture when viewed alongside rising auto payments and stagnant wages. For most households, there is simply no financial cushion left. When nearly 7 in 10 workers say that every dollar they earn is already spoken for, even a minor disruption, a medical bill, a rent increase, or a car repair can tip their budget into crisis. This vulnerability directly connects to what's happening in the auto market. As car ownership costs rise and incomes lag behind inflation, millions of borrowers are walking a financial tightrope. Missing a single payment can quickly lead to delinquency and from there, repossession. The PNC survey underscores that this is not merely an issue of poor money management, but a structural problem within the economy. Wages have not kept pace with the cost of living, while credit has remained easy to access. It's a fragile balance that leaves consumers, and by extension, lenders, exposed to even small economic shocks. In short, the 67% figure isn't just a statistic about personal finance. It's a reflection of the broader strain rippling through the American economy in 2025. When most households are only one paycheck away from financial distress, it's no surprise that sectors reliant on consumer credit, like auto loans, are beginning to show cracks. This widening financial strain is creating a two-tier economy, one in which the majority of Americans are cutting back and budgeting carefully, while a small fraction at the top continues to spend freely. The same forces that are squeezing middle and lower income households, rising prices, high borrowing costs, and limited wage growth, are having little impact on wealthier Americans whose assets have grown with the stock market and real estate rebound. As a result, spending patterns have begun to split along income lines, revealing a widening divide in consumer behaviour that mirrors the broader inequality within the economy. While most US consumers are still sticking closely to their budgets, top earners are spending to make up the difference. Americans in the top 10% income bracket made up nearly half, 49.2%, of total consumer spending in Q2, per an analysis of recent Federal Reserve data by Moody's Analytics chief economist Mark Zandi. That number is up from 48.5% in Q1, highlighting the growing divide between high-income earners and middle/lower income earners in the country. Consumers are adjusting in several ways. Leasing has rebounded, accounting for about 25% of all new vehicle transactions, according to Cox Automotive. For electrical vehicles, EVs, leasing is even more popular, making around 32% of EV transactions. This shift reflects an effort by buyers to reduce monthly costs and avoid taking on long-term loans for rapidly depreciating vehicles. Another key trend is the growth of online car buying and direct-to-consumer models. Online platforms and automaker subscription services have made it easier for consumers to compare financing options and look for better deals, an important development in a market defined by affordability challenges. One of the defining features of the modern auto finance market is the lengthening loan term. Edmunds reports that as of Q2 2025, about 22% of new vehicle loans are for 84 months, 7 years, a record high. Some lenders have even begun offering 96-month loans, though these remain rare. Longer loans reduce monthly payments, but increase total borrowing costs. They also mean that many borrowers spend years underwater, owing more than their vehicles are worth. This structure keeps repossessions elevated, even when economic conditions are relatively stable. While most lenders remain stable, the subprime segment is under pressure. Tricolor Auto Holdings, a Dallas-based used car dealership chain and subprime lender, filed for Chapter 7 bankruptcy in 2025. The company's collapse underscores the challenges facing smaller, high-risk lenders who financed cars at inflated prices during the 2021-22 boom. Still, the broader auto finance market remains intact. Major banks and credit unions, which hold the majority of auto debt, have kept loan loss provisions manageable. The Federal Reserve and analysts from TREP note that while subprime portfolios are deteriorating, prime credit remains strong. According to Edmunds and Cox Automotive, the average new vehicle price has leveled off near $47,000 in 2025, down slightly from its 2023 peak, but still far above pre-pandemic levels. Used car prices have eased modestly, but remain high, with an average of about $30,000 for a 3-year-old model. The market correction has been gradual. A shortage of inventory in recent years, combined with higher production costs, continues to prop up prices. However, analysts expect more downward pressure through late 2025 as new vehicle supply improves and more repossessed vehicles enter the used market. With total US auto loan balances exceeding $1.6 trillion, the sector plays a significant role in household debt dynamics. But despite elevated stress, economies see no immediate systemic threat. The rise in delinquencies and repossessions indicates consumer fatigue, not financial collapse. Banks remain well capitalised, and securitised auto loan markets are still functioning normally. The difference between now and 2008 is scale. Even at record levels, auto loans represent a fraction of total consumer credit. Still, they are a crucial early warning indicator for overall household health. Going forward, the auto industry faces a balancing act. Automakers need to sustain demand without relying on sustainable lending practices. Lenders must balance profitability with credit discipline. And consumers increasingly aware of debt risks are shifting toward shorter commitments and flexible ownership models. Technology and competition may help. The growth of EV leasing, used vehicle subscriptions, and online marketplaces are reshaping how Americans buy and finance cars. These innovations could stabilise the market over time by improving transparency and reducing costs. The US auto finance market in 2025 shows signs of stress, but not signs of collapse. Repossessions are at their highest point since 2009, but have not accelerated further. Subprime lenders face real challenges, yet the overall credit system remains stable. Rising costs, long-term loans, and stagnant wages are straining households, but adaptation is underway. In short, America's auto market isn't crashing, it's correcting. The next chapter will depend on whether incomes begin to catch up with costs and whether both lenders and consumers can learn from the excesses of the past few years. Thank you for watching. Don't forget to like, comment, and subscribe for more in-depth breakdowns.